After what was a really difficult year for markets in 2022, with inflation reaching a 40-year high, could it get any worse?
I do have concerns about consensus earnings risk in 2023. Again, particularly for the US market, when we look at some of those macroeconomic lead indicators, whether it be real money supply, ISM new orders, some of the housing data, it certainly suggests quite significant downside risk for US earnings in 2023.
I think labor markets are very tight throughout the West, and if not throughout the world, and that's going to help hold up the inflation rate. So it's going to prevent a hard landing if there is a recession.
You don't really want to be taking loads of risks. You avoid leverage. You avoid the high yield area. You go into your investment grade, high quality, and that really brings you into right now sort of triple B or single A and above sub 6 or 7 years, because you can get a good bang for your buck. It's still a hedge against some of the portfolios, but protects you should we all have to run to the hills.
Debt in the world is gargantuan. I mean, there are tears streaming all the way down my face, because I think this is one of the problems that we're going to see in 2023 and 24, is whether that level of debt is manageable. You've got to remember that something over £200 billion was squirreled away during the course of the pandemic, and I'm told a lot of that's still around.
All the crises that we see always appear in the same places. Derivatives, which was the LDI, and leverage. High yield, LTCM, all these kind of things. 2008, Greek debt crisis, it's all leverage and it's all derivatives.
The question of foreign exchange now, for me, in the next 4 to 5 years, is that the West pulls together and don't let China have a run at it. Because if China has a run at it and is disruptive in Asia and Africa and South America, then we're going to get turmoil. And, we're always going to have the differential wheat pound, wheat euro, strong dollar. That's going to be here, excuse me, in perpetuity. But what I think is most important above everything else is politically, the stability between the West is of paramount importance. Would you agree?
Completely agree. I completely agree. And I think the last thing I think most realise they want to go down is to the currency wars that we've had in the past. And, obviously, under Trump, it was one of these key planks was, WTO accession by the Chinese back in the 80s, 90s, and then the effective currency manipulation on a real effective exchange rate basis was what drove the competitiveness and job losses in the US market and the US economies.
There's no question that crypto is here to stay, and it's going to replace a lot of banks going over the thing. It's going to get involved in all kinds of different currencies and different ideas and commodities. But at the moment, it's really a bear pit.
It's still the Wild West. I mean, it's not regulated. Exactly. That's the problem. And until it gets regulated, crypto will probably be quite a strong investment class once it's regulated. Yep. The only danger with it is the amount of power that's required, and that's a potential issue. Although some changes recently, I think, mean that they halve the value of the amount of crypto every certain period, which means that it can easily go up.
Yeah.
So this kind of like harvest of crypto.
Do you think regulation will actually impact that negatively?
Well, look, I think I'm going to offer a slightly different view, if I may, and suggest that, I think there are two different things going on here, right? One is there's a technological revolution, and that the whole crypto thing has a role to play here because of the blockchain and the distributed ledger. So if you take a step back from the cryptocurrency and just think about what all of this technology is doing, it's putting buyers and sellers much more closely together than they've ever been in every walk of life, right? That's what Uber does, right? It takes out the closed shop of the licensed taxi cab and puts somebody who's willing to drive a car with somebody who's willing to hire one, right? In a much faster and more efficient way. So I think if you think of it that way, you can ask yourself whether that's a good idea in finance. Part of this is new. The technology is new, but the idea of a private currency is not new. So and then I think you have to think, what is a currency, right? A currency is a medium of exchange. It's a means of payment. It's a unit of account, and it's a store of wealth, like you said. Okay, now, the thing is, in the modern world, currencies are also legal constructs. Legal tender, right? You can't pay your taxes in this country without sterling. The government's not going to pay you if you're receiving some money from the government, if you're a supplier, or if you're on welfare, transfers, or you have some government bonds, gilts. You're going to get paid in sterling. The government is not going to give that up. The central bank is not going to give that up, and the financial system and the participants in the financial system aren't going to want to give it up ultimately, because if things collapse, as we saw in the GFC, in the global financial crisis, you're going to need the central bank to step in. So I really question whether the private currency element of this is going to take off as a currency. Now, as an investment, well, maybe, right? And that's where the regulation comes in. So I think the trouble that I have with this is that what is this investment a claim on?
Physical assets will struggle in that environment, unless obviously there is demand for the use of those through whatever engineering process is required. But yeah, so I see gold as doing better in environments where rates are much lower.
In terms of commodities, there's probably three factors. There's the cyclical momentum that's coming from China reopening, as David's alluded to. There's a structural aspect, obviously, from China, but I think in terms of the urbanization aspect, we've probably seen the majority of that over the last 10, 15, 20 years. But the second main factor is then the supply discipline that we've seen. So obviously, most of the miners in the GFC got themselves in serious trouble from all the M&A and balance sheet leverage that they put on, had to do rescue rights issues. So they spent then the next 5 to 10 years being very, very disciplined in terms of capex to depreciation and harnessing cash flow and building balance sheets. And obviously now, from an ESG perspective, and the supply side of that, that's also in certain elements restricting the supply. Yeah. So we've had a long period of restrictive supply in many of the major hard commodities. And then actually you've got this, what is more structural demand aspect on top. So I think the quote that I give sometimes is, I think the average electric vehicle versus an internal combustion engine requires something like 4 times the copper intensity. So you've got, an extra element of structural demand that you didn't have. So I think when you think of all those three factors together, it's difficult to be too bearish commodities. And then obviously the implications of that for us trying to fight inflation and what we're seeing post-Ukraine as well and what have you is clearly something that we need to be very aware of over the next few years.
We're going to have higher prices on a structural basis. That's going to be an inflationary pressure that central banks will have to deal with. But over the long term, if you think about what the transition from non-renewables to renewable means, if we're successful in that transition, it means that the marginal price of energy in the long run is going to be very low, right? So for a period of time, commodity-producing countries and firms are likely to do very well. And some of them may do well in a kind of structural basis for a very long time. But others are going to have to figure out a new business model for the long run, right? A new growth model if it's a country. And I think some of the oil majors are doing that already. For some countries, it's going to be more challenging than for others, right? It might be more challenging for potentially for Russia, probably for Saudi Arabia. And I think the leadership in various countries sort of understands that, and that's why there are a number of these changes taking place. Because the West is unwilling to buy Russian oil. And the East, right, China and India in particular, are very happy to buy Russian oil at a deep discount. And the oil price cap is that the G7 has imposed on Russia seems to be reinforcing that segmentation in the market. So we have different prices now for oil, which is essentially, not completely, but close to fungible. It's close to interchangeable commodity. It's trading at very different levels. And I think that's also something to think about. Europe is going to have to adjust to a higher, at least relative to Asia, a higher price for energy. Mm. And so, one way, if they don't do that well, it implies that Europe is poorer than it used to be, right? If they do it well, it means that Europe gets the green transition sooner and probably in a more productive and efficient way. So there's probably a long-term structural bet to be made there. I think, if I may say, the debt ceiling crisis in the U.S., that's a black swan that we've dealt with already. And so I think most people are fairly sure that it's going to be okay again this time. And I think that's probably right in the end, but it seems to me, we have the weakest speaker in the history of the U.S. And, you know, he's someone that's given away the farm in order to have this very weak position, right? He's made all kinds of concessions, you know, to the point where any one, you know, member of the party can kind of call time on his speakership that took 15 rounds and several weeks of voting to get to. So I think, you know, that the process of getting the debt ceiling raised may be a lot more complicated than people are looking or expecting. And we may not get there. And I think if, you know, if there's a, you know, quote unquote so-called technical default, I think that would be, you know, the financial equivalent of a thermonuclear accident, right? It would be a problem.
I think it's from my perspective, it's been obviously well flagged for some time as a possibility, and that's Itaú exit, in the sense of, you know, we've seen obviously Brexit come through. We've got, you know, in many respects, a more difficult thing to manage were the electoral populace in Italy to really turn against the EU. You know, you've got debt to GDP there, what, 140, 150%? You know, so, you know, even though Greece's at the time back in 2012 was 200-ish, you know, obviously the size, I think Italy now post Britain's exit is third largest in the EU. Yeah. So, you know, to me, it seems to pop its head up, and the Italian spreads seem to balloon out every kind of 9 to 12 months. And obviously there were questions over COVID in terms of the disbursement of various funds and what have you. So that would be the one for me that seems to pop its head up and that could really presage, you know, another financial system crisis.
Is ESG actually even important? I mean, should people just be concentrating on returns, as you said?
Nick and Bryn answered that question. There's a long-term outlook, and it is very important. And short-term, which is basically what I was talking about before, should be taken in context rather than out of context. ESG is established. It is here. It is going away. It is respected by an awful lot of people. I take Bryn's point about smoking, and perhaps, no offence to the shareholders of Boohoo, but I don't think the company's behaved terribly well over the years in terms of looking after their staff. And I get that, but what I don't really accept in what I call the ethical is things like oil, even though I know we're going green and everything else, but we've got oil here for 15 years, like it or not, too bad, because the transition period is going to be significant, and that's the reason why I really flagged it up.
If you could pick one thing that for you that investors should be looking at this year, what's on the horizon for you?
I think, to be honest with you, because of the imponderables which we've all discussed, is that in terms of equities, you have to stock pick and you have to sector pick. And if you get those sectors right, I think you'll be very comfortable going through 2023.
The market won't bottom until effectively it's got comfort that clearly one of its largest components, the consumer sector, is starting to at least see a second derivative improvement.
I would say stay in quality, systematically important businesses. Avoid too much cyclicality, leverage, where you think there's gearing, derivatives. They're the kind of places where the kind of things are going to blow up.
We're in an environment where you need to be much more concerned with risk management than with return seeking, right? And I think that applies to ESG as well, right? Part of the point of ESG is to reduce these catastrophic event risks, whether it's a badly run company or a badly run, you know, climate system in the world. So I think we need to be more careful and more thoughtful. Well, I think that's probably a pretty good thing, right? I mean, this free money was not really a good life, right, for most people.
Thank you, David. Thank you, Nick. Thank you, Bryn. Thank you, Anna. Really appreciate your time and your views. Thank you so much to everyone for joining us, and we hope you've enjoyed it.